Good morning, everyone. Today, I'm very happy to have Melanie Stockigt here with me. Melanie is one of the founding members of Tantalum Capital. She's also head of fixed interest here and manages all of our fixed interest portfolios. She also gives input into the fixed income allocations in our multi-strategy portfolios. Melanie, thank you so much for joining me today.
It's a pleasure to be with you.
Mel, you've been managing money you've been in the market since 1998, and so you've seen a number of different crises through your career. How is the crisis that we find ourselves in today different to the other crises that you've managed money through?
Yes, indeed. So this is obviously quite a challenging crisis from a macro perspective, because if you think about it, it's not only a supply shock, like an oil price crisis, but at the same time, it's also a severe demand shock. And it has this unique characteristic of governments actually telling people to stay at home and not participate in economic activity, which is obviously quite unique. It could perhaps have some similarities to a natural disaster, but natural disasters are quite quick. This is going to be a lot more durable, particularly if we see second and third waves. And also natural disasters are localized. This is a global pandemic. Perhaps also some similarities to a war where people stay inside their homes and are fearful to spend. But this crisis obviously has so many differences to both of those examples. Another key difference would be in the way that monetary and fiscal authorities have responded. Central banks have provided extraordinary support to liquidity in markets, both in terms of the size, much larger than previous crises, but also in terms of the speed. They reacted incredibly quickly. And governments have also provided extraordinary fiscal support. So even going so far as to paying people to stay at home and not go to work, which is very unusual. So yes, there are some similarities and parallels, as there always are to previous crises, but this one's also quite unique in its own way.
Mel, have you been surprised at all by how fixed income markets have reacted to the information and the crisis that we're seeing playing out at the moment?
So actually not really. So this is pretty much a textbook response to an extreme global risk-off event. And what I mean there is that first thing we saw was that global risk-free rates, for example, developed market bond yields, immediately rallied quite significantly. In fact, we saw the US 10-year Treasury closer to 2% earlier this year, in January, rallied quickly and dramatically down to just 0.5%. And at the same time, risky assets were sold off quite dramatically. There I'm talking about equity markets, but also emerging market assets, such as emerging market currencies depreciated significantly over that time, and EM bond yields rose across the globe. What made things worse for us in South Africa was that the timing obviously coincided with the Moody's downgrade to sub-investment grade. So SA yields were under particular pressure over that time. Another perspective to have is that really within a multi-asset income portfolio, we suffered very similar characteristics to what we saw during the global financial crisis, which was an extreme risk-off event, and the correlation between our fixed income asset classes rose significantly. So if we think about that, bond yields rose across the curve, inflation-linked yields rose, credit spreads widened, listed property prices fell quite significantly. So that usual benefit of diversification that you have, being able to invest across different fixed income asset classes, was disturbed over that period. Coupled with the significant lack of liquidity that we saw in the SA bond market in March and April, made this a particularly challenging time for fixed income investors.
Mel, could you perhaps give us some insights in terms of how your portfolio positioning has changed in the last 6 months, particularly looking at from a duration perspective as well as your positioning on the yield curve?
Absolutely. So the market sell-off that we were discussing did provide attractive opportunities in March and April, and we increased our exposure to nominal bond yields at these attractive levels, taking duration to what we would consider to be above neutral, so overweight bonds in all of our portfolios. In multi-asset income funds in particular, we saw a lot of value out to the 10-year area of the curve, so really our 2023s, 186s, 2030s, where there was a lack of liquidity that left these yields very high relative to the short end of the curve. And at the same time, the Reserve Bank was cutting interest rates quite aggressively. So we saw a lot of value in that area. At the same time, the very long end of the yield curve did also steepen further over that time. And we took small additional exposure to that area of the curve. We do, however, recognize that South Africa's fiscal position has deteriorated markedly over this time. The curve should be steep. The risk premium at the long end is justified, and we're a lot more selective about our positioning there.
Mel, if you look at where you're seeing particularly good opportunities within your investment universe at the moment, I know that you have a number of different building blocks that you use. Perhaps just highlight a few of the opportunities that you're seeing across these building blocks.
Of course. So I suppose if we start at the very, the very first building block that we utilize, which is really money market rates, so cash rates and anything in the shorter part of the curve, that's obviously looking a lot less attractive to where we were in the past. So interest rates have almost halved since this time last year. In fact, the SARB have cut rates almost 3%, 2.75% this year alone, to current levels of 3.75%. So cash as an alternative is obviously looking less attractive relative to other fixed income asset classes as it was previously. We've discussed some of the actions we've taken in the bond curve, so opportunities out to the 10-year, some selective opportunities further along the yield curve. In terms of the corporate bond market or credit, we did see spreads widen a touch over this crisis period. We are quite cautious still on this space. As investors, we have very little visibility in terms of how corporate balance sheets are likely to weather this crisis. But within the banking sector, we actually saw some very attractive opportunities in the secondary market for senior bank debt. So obviously there may have been some fixed income portfolios that were looking for cash over the time and were selling some attractive assets. We took full advantage of that. We've been quite cautious, though, going further down the bank's capital structure. And really what I mean there is looking for subordinated debt or alternative tier 1 instruments. Because one thing we know for sure is that bank credit losses are going to be high in this cycle. Looking at another pillar, inflation-linked bond yields. Now, inflation isn't likely to be much of a problem in the near term in South Africa. In fact, the most recent CPI print was just over 2%, 2.1%, which is even below the SARB's target range of 3 to 6%. However, if you have a look at some of the shorter dated inflation-linked bonds, for example, a 5-year maturity linker, you can pick it up at a real yield of around about just under 4%. You don't need much inflation compensation on top of that to be able to outperform cash. Moving to a more riskier building block, listed property. I know that's quite topical. Very challenging at the moment to value, and optically, obviously, the property prices are looking quite cheap. But we've been saying for some time that the sector entered into this crisis already facing a lot of headwinds with the low domestic economic growth environment that we've had. And those headwinds have clearly only intensified during the crisis. We expect property companies to face both income statement pressures, really revenue pressures due to lockdown itself, but also we anticipate very challenging lease negotiations with tenants in the coming periods, but also balance sheet pressures. Most of the counters have got higher gearing than they would have wanted to enter a crisis with, coupled with the time when property valuations are likely to fall, does leave that a little bit of a conundrum for them. So taking all those factors into consideration, we would anticipate that property distributions to shareholders are likely to be lower than had previously been anticipated. We expect most of the counters to survive from a liquidity and solvency perspective, but not necessarily to thrive. And what this means is that property in its current form doesn't play the usual role that you would want it to in a multi-asset income fund by providing a steady and predictable inflation-beating income stream. So the exposure that we do have to this sector is quite small. It's around about 2% currently, concentrated on those counters that we think carry good balance sheet strength and more likely to maintain their distributions in the near term.
Now, one more question from me. We all know that you never stop learning in this industry. Over the last 6 months, has there been a particular lesson that you've learned, or perhaps just a reminder of one?
It's such a good question. I suppose one could say that when the facts change, don't forget to change your fair value. And what I mean by that sounds a bit tongue-in-cheek, but essentially it's quite tempting for all of us to look at yield levels in the bond market, particularly at the long end of the curve, and compare them to previous crises, for example, Nanny-gate or the global financial crisis, and to say there's clear value because yields are higher than they were at those times of stress. But it's so important for us to remember that South Africa was a decade ago a solid investment grade issuer. We're now a much more fragile sub-investment grade issuer. And the risks of investing in bond yields, particularly at the longer end of the curve, are much higher than in the past. So one wants to take advantage of these higher yields, but also recognize the risks that we face in portfolio construction. And this really explains why, yes, we have taken duration of portfolios to above neutral levels or overweight, but we're not significantly overweight the asset class, even at these levels. we would require greater confidence that South Africa's fiscal outlook is going to trend closer to the active scenario rather than the passive scenario outlined in National Treasury's recent supplementary budget.
Melanie, that was really interesting. Thank you so much for your time, and good luck in the coming months as you navigate this new normal that we find ourselves in.
Thank you so much.